Hi everyone, welcome to this lesson. This lesson's going to be very special because in this lesson we're going to go over, as you guys see here, many different assets all over the financial sector, and at least the assets that have been around for a long time. I'm going to grab many of the popular assets that people try to place their money to secure their wealth, whether it is to save more money or increase that amount of money throughout time, and really just the safest investments that society in the US tends to put their savings in, right, in hopes to grow that. So one of those, of course, is the US dollar, right? Many people like to hold cash and open a bank account and open a savings account and so they can save for buying a house, buying a car, money that you can save to spend it to an essential need that you will need later on, right? That's kind of the point of the US dollar, and purchasing power for someone to pay for a large purchase that they can hold for a long time, whether that's a liability or whether that's an asset. The other is gold, which is very popular too. Gold, a lot of people like to invest in gold to counter fight the US dollar, where the US dollar can get lower preference and lower amount of demand for people, and especially with inflation too. So people like to tend to go to the gold as a safekeeping for their wealth in case of something, I don't know, apocalyptic happen, something extreme. People can put a lot of their money into gold in the case that many of the different assets might be abolished in terms of governmental issues, maybe an uprising, right? People tend to move into gold for any of these extreme scenarios. Real estate is also another popular asset. It's very, very, very popular asset. A lot of people like to get into real estate for many different reasons. One of those reasons could be to also grow their wealth, into duplicating their wealth, to quadruple their wealth. A lot of people just want to get into real estate to become rich or millionaires, which is they get out of their jobs because they're getting cash flow and trying to become financially independent and duplicate that cash flow by refinancing their properties and just creating a real estate empire and creating a lot of passive income, right? A lot of people like that. They also just like to maybe do this to pass it on to one of their children or inheritance, or really just a big asset empire. And also partially because of a company, a lot of people like to enter into real estate, which could be seen as an investment where they're looking for a very, very long time. In the case that they want to somewhat retire, they have all these different properties that are paying them passive income, and they don't have to worry to go to a job and trying to sustain their final days, their own health conditions and different problems that you can get when you're elderly. Those are the pretty big areas that people like to go into real estate most of all. Another asset are bonds. Now, there's many different types of bonds, but the most widely remember, all these assets have existed, well, here since 1929. So this video is solely going to be dedicated into seeing how well did these assets correspond in with all the events that's happened to the world for the last almost 100 years. And I wanted to create a wide, diverse area where we can compare each asset in very different areas of types of investments, like bonds to real estate, from real estate to the markets, and so on, But for bonds, the most widely and solid bonds that have existed are corporate bonds and US Treasury securities, right? So specifically in corporate bonds, that would be the BAA corporate bond or the AAA corporate bonds. Triple A corporate bonds have lasted longer, as you see here, but there's also the BAA corporate bonds, right? And many of you might be saying, like, what's the difference between this? BAA corporate bond stands for a medium-term risk in terms of default, right? In a AAA corporate bond, it's a higher rank where there's a much lower risk of a default with that bond. But of course, because of this lower risk, there's a lower yield compared to the BAA corporate bonds. So AAA corporate bonds always have lower yields compared to the BAA corporate bonds, but the BAA corporate bonds have more risk that there could be a default compared to the AAA, right? And many of you might be saying, okay, what's the corporate bond though? Okay, well, a corporate bond, right? A corporate bond is a bond that's issued by a company, a corporation, right? That could be Apple, that could be Metaverse, that could be Microsoft, so on. Many of these companies issue out corporate bonds. And the difference between a corporate bond and a share is that when you buy a share, remember that you're buying an ownership of the company. You're buying a piece of ownership of the company. So when you buy one share of Apple, you own a very small percentage of Apple's entire business. Now, unlike corporate bonds, you don't own the business, but what you're simply doing is that you're giving the company's funds, And based on that funds that you give them, basically you're lending them money, they're going to pay you interest for that loan amount that you gave them, right? So when you buy a bond for them, they will incentivize you by paying you yields and interest for your investment in them. And what they're going to use with these funds is that they're going to finance their operating activities. That could be expenses, R&D, any of these things. They will use that financing. They're really financing to scale their operations. That's the point of corporate bonds. And that's the same thing with bonds in general. Those are for corporate bonds. That's why it says a default risk, right? Because a company, that's completely different from a treasury security, because of course corporate bonds automatically have more risk compared to maybe a US treasury bond, because a corporate bond is behind a company, right? And you need to make sure that the company's solid enough that they can pay back their lenders the sufficient amount for their lenders to be happy and lend money again, right? So that can keep happening with credits. For US treasuries though, it's so much less riskier, but of course there's a lower yield with that, but it's less riskier because you're lending money to the government now. And of course the government is much more stronger than any company, because a government's backed up by all this surplus amount of cash and surplus amount of economic consumption with economic powers of military powers. It's just not very comparable that of course a US government is obliged to pay the exact amount that a person lends them, right? And they will pay that. They have to pay that, even if there's a economic crisis. Of course, if there's an economic crisis, that will affect the yield of the treasury bond in the future, but you will get paid the amount that they promise you to pay, right? And that's the difference between a corporation. A corporation, on the other hand, can default on this. So of course, when you want to get into a corporate bond, you want to make sure obviously that that company is very, very strong, that you know with confidence that they will pay you back many, many years to come, because they're a very strong company. What is the 3-month T-bill? Well, that stands for the 3-month treasury bill. It's a form of treasury security similar to the US treasury bond, but the bill is similar to the bond, where US treasury bonds are the longest value security in the US treasury, right? Because US treasury bonds last for 20 to 30 years, right? So you're going to get paid the full amount in a bond in 20 to 30 years, but before that reaches maturity, but during this time, you're going to be paying yields, right? If you sell before this time, if you sell before the maturity date on the bond, the selling price is going to create a loss to what you bought. When you buy a bond, you're buying a set price on the market price, but the reason why people get into bonds is because 2 reasons. One, they see, okay, the bond market price is at this number. I'm just giving you an example. It's at 1. It's at 1, but let's say the maturity is at 2. Okay, so you know that you're going to make inevitably double of what you're paying. So you're going to make really 100% of your investment. So you'd be inclined to do that, but this will occur in 20 years or so. This is just an example. This isn't going to happen with bonds, but I'm giving you an example because it's like that. So what they do is that they're only going to pay you that full amount if you let the bond mature itself. And the bond matures when it reaches the maturity date, which is the set date, like 20 years or 30 years. But if you sell it before, for some reason, you will sell it at a loss, because you're not selling it at the price of maturity date. You're going to be selling it at somewhat what the market price is at, and they won't give you the yields afterwards if you even do that. So it's definitely not a good thing to buy a bond if you're looking for short-term results. And that's actually exactly what happened to Silvergate and Silicon Valley Bank a few months ago. The problem was that they put too much money into these marketable securities, and the reason why they put too much money Fastly was because they needed the money back to pay some leveraging point, especially that these banks were, not only were their clients risky, because the Silicon Valley Bank is filled by IPOs that just started that are not even making any money yet. So they're by nature high risk clients, but they were also involved in a lot of cryptocurrency. They were a lot involved with Bitcoin and cryptocurrency, and of course we all know what happened a few months ago with that, especially with the scandal with Sam Bankman-Fried, and that whole scandal with FTX, and all these banks. They were just involved in this stuff, but they needed the money immediately. And what they did was Silicon Valley Bank was forced to sell their bonds before it matured, and they lost about like $80 billion, and that caused an enormous bank run, and Silicon Valley Bank had to be bailed out by the government. So yeah, it's not a good thing when you hold bonds and you're expecting for a high profit easily. The whole sole purpose of a bond is to hold them for many decades. That way you earn that profit by the maturity date. Now, as a 3-month treasury bill, it still pays you exactly similar as a bond in the maturity date, but they have a shorter term maturity date. That could be 4, 8 to 16 weeks. and it's much faster. So that could be another option. But of course, a treasury bond is always going to have the highest yield because it's the one that has the longest maturity date, right? So whichever one has the longest maturity date, they're going to pay you more of a yield for that because you're letting, think about it. I mean, if you're the government, you would want your people to still lend you money and still like have the mentality that they don't want to take out the money. Yeah, they want you to do whatever you want with it for many, many, many years. And then you'll be happy enough to pay them a high premium because you know that it's a low risk. You know that during 20 years, you're going to make much more money. And it's a much safer deal to go about that. That's why in US Treasury bonds, they're going to pay you more than in 3 months Treasury bills. But unlike bonds and Treasury notes, T-bills do not pay periodic interest payment to investors, right? So the difference between a Treasury bill and a Treasury bond or a Treasury note is that they don't pay you interest payments. They only pay you the amount of your maturity. So specifically, so you guys can understand, the Treasury bill are auctioned off to investors at a discount always. And the discount is always going to be discounted from the face value. The face value just represents the price that the bond will be at the maturity date. So obviously, whatever price you want right now, you want to make sure that the price that you're paying now is much lower than the face value, because that face value is what really the government's going to pay you for your services in lending them money, right? But Treasury bills don't pay you interest payments. They just pay you by amounts until you get the full amount of the face value. That's the difference between the Treasury bond. The Treasury bond does also that. It does pay you the face value, but it also pays you interest payments. So that's what I just said. It's more incentive for the Treasury bond, but only if you don't need the money. You just want to hold it there and you want to collect really passive income from the government there. Now, for the S&P 500, I think you guys know this because I explained this the last lesson. Remember that the S&P 500 is the Standard & Poor's 500. It's the index. It's an index of all the 500 biggest companies in the world in one index. And an index, remember, an index is a simulator on the price of the assets it currently has, of course, deducted by its liabilities. So whatever the S&P 500 is at, if it keeps going higher, that goes to show that companies are making more and more money. That's why I said last time that the reason why the S&P 500 will go up and has gone up always from the past 5 years to the next 5 years, it's always going to be higher, is because, well, if we look back 5 years ago to 10 years ago, companies by nature, out of their assets and debts, their assets are always going to increase. I'm talking about big companies in the S&P 500. As long as America is intact, these big companies' asset columns are going to make much more money, and that's going to increase more of their assets compared to their liabilities. So net in total, you're going to have more cash, more positive numbers compared to that debt. And those positive numbers are going to increase and increase and increase because a lot of people want to consume still all these sorts of companies. So that's why the S&P will keep going up. And that's also the reason why S&P 500 has always beaten a lot of different investors, especially in Wall Street. The S&P 500 already has all these companies, and instead of investing in a few companies, you can't always be right, not all the time, but the S&P 500 has proved to be almost all the time right because it doesn't have to invest in a few companies. It already invests in everything. So it's basically like the economy. That's why they've proven to go up enormously on that, because the asset column with the debt, the assets have more than enough improved by time and kept improving. And by that nature, that's why the S&P 500 has risen since 1980 to now, right? Back in 1980, I don't remember specifically, but if I look at this, I have it right here. In 1980, the S&P was at $140. Right now, it's at almost 4,000, right? And that just simply means that companies have been able to produce more money, have been increasing enormously in earnings, and have been able to produce more in output to people, and people want to consume more of products, especially the way in systems like technology and all these things are evolved to easily access these products. So that's why, nonetheless, many people are just skeptical and still don't know whether the S&P will keep going up and keep going up. It will go up. It's not my opinion. It's done it. And as long as people still want to consume and keep consuming onto that fact, why do they want to consume? Because no one wants to live worse than they was yesterday. The US is very capitalistic, and so is China. And many of you might be saying, like, China? Yeah, China's very capitalistic. Many people confuse them that they're very communistic. Sure, they have some socialist beliefs that's just their system, but China did not grow enormously in economic power because they were all communists. No, they used many capitalistic practices. There's no way to grow a huge amount of money and a huge amount of estate in the country by grabbing the money of someone else. That's not work. You have to incentivize the producer to helping people. And of course, the US will always have that, I guess. And I don't know, many in the future, some random crap might happen, but for right now, that's why I said, like, as long as the US stays intact, companies will make more and more money. People want to consume more and more products from these companies, and that's never going to change. And that's going to rise the S&P 500 because the S&P 500 is filled with all these 500 biggest companies. Now, that's for the S&P 500. For the Dow Jones is a portfolio of the 30 biggest blue chip companies also in the world. So if remember, a blue chip company is a branded, strong, sturdy business that has a long history of strong revenue and a strong income, a very recognizable brand. Most of all, a blue chip is a very recognizable brand. It's a company where you talk to a 4-year-old and they know the company that you're talking about. For example, if you talk to a little kid and you tell them, do you know Apple? And they will, I think, very most likely know what Apple is, at least if you're not in a very poor country. But here in the US, like if you ask a little kid, they know Apple, they definitely, I'm pretty sure they know Apple. If you tell them if they know Thermo Fisher, that's just not going to happen. Thermo Fisher is yes, it is a big company, but it's not a company that everyone knows. Like, it's not a company that, all the way from a doctor to a person who cuts grass in the yard, or a person who works in a gas station, it's just every parts of different financial circumstance and different careers. Everyone knows that company, and that's called a blue chip stock. That could be Apple, Microsoft, Google, Coca-Cola, definitely Coca-Cola, Procter and Gamble, and Metaverse, right? Facebook. Everyone knows Facebook. Everyone knows Instagram, WhatsApp, many of these things. So that's the Dow Jones. And again, the index is a simulator of a set price by the assets and liabilities. It just sets the price of the total equity of all these assets. And this, of course, the equity is always going to keep going up because what they have in total, they're producing more money than what they're losing in cost. And that's going to keep happening because people want to consume this. They want to consume those products. And that's most of all with great businesses. That's why the Dow Jones and the S&P will keep going up as the index. But an index, you can't buy an index. I'll explain that further. You can't buy an index because it's a simulator of these companies. In order to buy an index, there's two ways. You have to put money in the S&P 500 from an index fund, or you have to put money in an ETF. But specifically, index funds that track the S&P 500. And those I'm going to explain in full depth. That could be the Vanguard, Fidelity as well, or the Charles Schwab's. There's different index funds. The most widely popular is Vanguard, but it solely depends on your own preference and whether you can get an account based on your location. And an ETF, the best ETF though, with no doubt, that tracks the S&P 500 is the SPY. And both the SPY and Vanguard pays dividends. Okay, so those are all the assets really that we're going to look at today.